were a lot of deals that were underwritten on razor thin margins and assuming incredible rent growth, and they are not going to be able to sustain this uptick in interest rates once their debt comes up for and they've got to renew or get new, not renew, they've got to find new debt or they've got a balloon payment or whatever it is, and they have to refinance where they got bridge debt at 5% and now bridge debt's going to be 8.5%. I think there are going to be some people that have to sell, and there may be some deals coming out there. Right now, that's not the case. There is, like I said earlier, such a big gap between what sellers' expectations are and what buyers are. But there's so many little things, and I won't bore everybody with it, but interest rate caps that are rolling off that were artificially keeping their interest payment low. And now if you have to buy another interest rate cap, like we bought one for $25,000 to protect our floating rate bridge debt, that same interest rate cap would probably cost $500,000 now. It's that different of a market. And when that comes and you've got to refinance, they're either going to have to capital call all that money to protect their interest rate. It's going to be, I think it could be a little bit of a mess out there over the next year. It's going to be some choppy waters.
Yeah, it's funny you bring up Old Capital. They're one of the podcasts I definitely listen to and have learned a lot. And so
Yeah, they're great.
Yeah, they really are incredibly experienced. Michael Becker, who I've had on the show, just put out I think his quarterly review or quarterly newsletter where he pretty much spelled out what you were saying. I mean, here's the thing too. I mean, if somebody paid a 4 cap for a Class C a year ago, and now it's at 5.5. That's a world of hurt right there, irrespective of their borrowing costs going up.
Absolutely, yeah. It's the perfect storm of cap rates have gone up, which in large part is because interest rates have gone up. But cap rates have gone up, interest rates have gone up. It's just making it a very trying time, and we're just underwriting stuff all the time. And we're putting on paper and sending to the seller, like, look at our numbers. We'll show you why this doesn't work. There's no money in this thing, but they've just got these, prices from early or late 2021, early 22 stuck in their mind. Where, and like at the time it was right, but a broker gave them a value, broker opinion of value, and said, hey, we think it's worth this much. They've got that stuck in their head, and they're not willing to budge on it very much. But I know that, in talking with a bunch of brokers, they're advising clients that, prices have gone down probably 15 to 20% from where they were. So unless you're willing to come to grips with that, you're not going to get a deal done. And I think that's why there are a lot of deals that aren't getting done.
Right. Well, because the other thing is, if you're trying to buy at 5.5% cap, you're on. I would imagine the lenders are going to be requiring you to put 50% down, and how do you rate it? And then does the deal float? Does the deal even make sense? Can
Right.
you raise money, et cetera, et cetera? It seems like it's kind of a Mexican standoff at this point.
Yes, it does. But it's a Mexican standoff until they have to refinance their loan, and then something
Right.
has to happen. Like
Right.
that's going to be the shoe that drops. Where, okay, we got to do something.
Right. And I'll tell you what, there's going to be a lot of LPs that are going to lose their money.
Yeah. I just listened to something. The guy said that 2023 is going to be the year of the capital call, which nobody wants to hear for sure. But yeah, it's going to be tough sledding this year, I think.
Very interesting, because there are a couple deals I'm in, not too many, knock on wood, but there might be. I don't know. I put myself in that position of, if I got the capital call, would I come up with more money or get diluted? And knowing myself, I would not put a penny more in. I'm like, I'd just be willing to get diluted and take the lesser. In my mind, that's the lesser of two different risk decisions.
And hopefully people like you who've invested, over the last 5-7 years or even longer, hopefully everybody's made a bunch of money, and a little bit, if you have to do a capital call or get diluted and don't make as much money or lose a little money on a deal, I'm not trying to be cavalier about that at all, but hopefully everybody's made some money, and it's an investment, and there's a chance that you can lose, and hopefully most of them have made money, and overall, hopefully everybody's done pretty well.
Well, I think that's you are a benevolent soul. I think unfortunately, I think I don't know about the lion's share, but let's put it this way. A lot of deals, there was a lot of velocity in the last 24 months. Let's call
Yes.
it 18, 24 months where those people bought at the top.
Yeah, that's true.
So it's not going to be, well, hey, I had so much daylight in it anyway. I'm just not going to make as much. They're going to be people that get wiped out, and they're going to learn some costly lessons.